This is HFO's Multifamily Marketwatch, presented by Pacific Exteriors Northwest, a contractor specializing in siding and exterior envelopes, delivering exceptional quality and service for over 30 years. By Aprio, combining DeLapp's Pacific Northwest experience with Aprio's global resources to offer unparalleled tax, wealth management, and advisory services for real estate owners. And by Kennedy Restoration, helping residential and business owners recover from fire, water, mold, and storm damage.
Welcome back to Multifamily Marketwatch. I'm Greg Frick, partner with HFO Investment Real Estate. Today we have with us Josh Goodell. He's Senior Tax Manager at Aprio, which used to be DeLapp CPA firm. So hopefully the name change and the move has been beneficial. I know you guys are now one of the, so now, isn't Aprio like one of the top 20 CPA firms in the United States?
Yep, top 20 firm.
So you guys got a lot more services now, I'm sure. Well, we
right.
brought you in today to talk a little bit about cost segregation. I mean, people hear about it in our industry. I don't know how many people actually do it, especially in multifamily, if they're not involved in new construction. So thanks for coming on and, kind of enlightening us, telling us what's going on with that.
Yeah.
And maybe also we're going to talk a little bit about, regular depreciation versus bonus depreciation and what has changed in 26. Maybe you can shine some light on that.
Yeah, sure. So depreciation is this concept of spreading out deductions over multiple years for an asset that you would use for multiple years. Bonus depreciation is a special tax incentive that front loads or accelerates those deductions into year one, the asset that you got the asset. So that's what we're talking about today, is this acceleration, moving the deductions from periodic into 1 year in particular.
And for like multifamily, which our audience is, it's typically if you don't do accelerate your 27 and a half years, straight line depreciation. Yep. This allows you to take more depreciation on the front end.
Yep.
Gotcha.
Yep. And just to clarify, bonus depreciation applies for assets that have a tax life of 20 years or less.
Okay.
And so you just noted that apartment buildings for tax are depreciated over 27 and a half years. And where the bonus depreciation comes in is from the cost segregation study that you started with.
Okay. So it's using that study.
Yep.
So why don't we explain a little bit about how does somebody go about getting, to unlock this bonus depreciation?
Yeah, so it's going to be the cost segregation study. So you buy a property, you have to depreciate the building over 27 and a half years.
Now, it doesn't have to do with the age of the building. It's when you acquire it?
It's when you acquire it, 27 and a half years for the most part.
Okay.
So this cost seg study is essentially an engineer's review of your building where they come out and say, well, these pieces of your building actually qualify for that less or 20 years or less tax life. So 5 years might be your appliances. 15 years might be your parking lot or some of the landscaping. And they'll break that out.
Component by component.
Exactly. And then you can depreciate it faster. And now bonus depreciation after the 2025 tax law change is at 100% for most of 25 and now all of 26.
Join the HFO community and get weekly multifamily intel. Click to subscribe.
So, because there was a thought, where it was going to not go to the full 100%, so that's back in place now.
It's back in place now, 100% for federal.
For federal, yeah. This is all about federal.
Yes.
Yep. And what in 27 does it go back to a portion of that?
It's permanent going forward.
Okay.
So the tax law would have to change somehow for it to no longer be 100%.
And for it to start, you have to have ownership of that property within that tax year.
Yeah, for the bonus depreciation, it applies when you place the property in service.
Okay.
So if you buy a property that's already being rented, it's in service once you acquire it.
Got it.
If you're building it, then it kind of comes down to some questions of when did you start renting it.
So for an example, I buy a $3 million property. What does that look like in dollars? If we're saying a standard, again, it's going to change because of the age of the components. Yep. But what would that look like on standard depreciation versus, the bonus depreciation?
Yeah, so on a $3 million acquisition, you would first break out a portion of that to your land.
Right.
Because
again, we don't depreciate the land.
That's right.
Right.
So let's say 20% is land. That leaves $2.4 million to depreciate over 27 and a half years if you didn't do anything further. A cost segregation study on the average apartment complex can break out 25 to 35% of your building basis into these lower 5-year, 15-year assets. So if we were to say 30% of that, $2.4 million, that puts us at $720,000 of these low life assets
that you can shelter that or
that you then
depreciate
qualify
that,
exactly for the 100% write-off if all the timing works.
And now what about owners that didn't just acquire a property? They've owned it for a long time. And is there something to do there?
Yeah, so you are able to do the cost segregation study on a look-back basis.
Oh, you can? Okay.
Yeah, so you could do the study on the property that you already own, and then you're able to file a form with the IRS. It's Form 3115 for whatever that's worth.
Yeah, for people taking notes at home. Yeah.
That's right. You file this form, and you're basically able to compare how much depreciation have I taken so far to how much would I have been entitled to had I done this study in year one. And then you get to catch up that difference in the year that you're filing for. So you don't have to amend returns or go back and change.
So you're not amending your old returns, you're just doing a catch up on the current return.
On the current return. So that could be your 2025 return if you were still filing, or your 2026 return, filing next year.
And the process to get this going is, again, as you brought up, it's this engineering study by an engineering firm that go and break up the components.
Yeah, and Aprio actually has a cost segregation team that can do that. So we have engineers on staff for this purpose.
Is there ever a time where doesn't make sense to do this?
Yeah, it could depend, right? If you don't have the income to utilize the losses that you're trying to accelerate, it might not make sense.
So continue on the straight line.
Potentially, if you're thinking about selling the property next year and you're going to accelerate deductions just to the next year pick it back up again, your value's limited.
Right. Okay. So if you've got a longer term where you've got enough income to shelter, and you've got a longer term hold horizon.
Yep. Exactly.
So what you bring up about losses, and as you do this accelerated depreciation, your basis is going down.
Yep.
So you have this, big paper loss. Can you use that against your W-2 income, or is it just against income from the your rental properties?
Yeah, so it depends, is basically the answer. When that paper loss flows through on your tax return, whether it comes from a partnership or it's on your personal tax return already, it's got to jump through some hurdles in order to touch your other income. The most common hurdle that real estate investors get caught at is this passive activity loss limitation. The reason is because rental real estate is by default passive. You can't do enough activity to make it non-passive by default. Now, the way that you can do that for some of the listeners is if you're a real estate professional. And if you're a real estate professional, which means that you work 750 hours during the year,
in that business,
in a real estate business, and more than half of your working time. So you mentioned the W-2 earner. If that's not in a real estate business, it might be hard to hit that half of your working time. Right? So if you can hit the real estate professional status, you've now unlocked this default passive. And now you can analyze for non-passive like you would with any other activity.
And if you have a couple involved, a married couple, one's W-2'd, one is real estate, does it, because they're filing jointly, that goes there?
Yeah, exactly. So one spouse needs to meet this real estate professional on their own. So if one spouse is the W-2 earner or has the business income, the other spouse is the real estate professional, you've now unlocked it for both spouses to use. And now you can pool the hours together to determine whether or not you're really hands-on in your rentals.
Oh, you can? Okay, interesting.
Yeah, just like you would with the business. You're analyzing how much time do you spend in your business.
Got it. Okay.
Yep.
And again, I would say to everybody, talk to your tax professional on when you, yes.
Yeah, there's a lot of complexities here, a lot of nuances in the rules that we're moving through.
So then there's, what about recapture? I took this, accelerated depreciation. I'm now going to sell or do something different. I mean, what does that mean in terms of the recapture with the IRS and things like that?
Yeah, so when you take depreciation, you're lowering your basis every time you take a deduction. And what that means is that in the future, when you sell the property, presumably at the same or more than you bought it for, your gain's going to be larger by the amount of depreciation deductions that you got to take. The portion of that that's due to those deductions is the recapture portion.
Right.
All that is, I mean, you have to take depreciation. There's no other option. The IRS says if you don't take depreciation when you sell the property, we're going to pretend that you did.
So
whatever you were,
yeah,
whatever you were entitled to. So you have to take it. Really, all we're doing by accelerating is we're moving deductions into the time you can use them and creating an opportunity in the future to plan for the recapture event. So,
and then what about, this is again on the federal side, you know, most of the listeners here are Oregon and Washington. Let's start with Washington. So it's got no state income tax. Well, they're talking about doing some stuff with that, but so does it affect that at all, or where does that fall in?
Yeah, so for Washington, there's no state income tax today.
Today, yes.
In 2028, there is an income tax coming in for households over $1 million. It's currently being challenged, and we don't know what the result will be, but as of now, it's on its way.
And will that be $1 million of active income or $1 million in passive income?
It would be $1 million of taxable income.
So it doesn't matter?
It doesn't matter. It would be a new income tax in Washington. Washington also has a capital gains tax, which currently excludes real estate sales, which is great.
Yes.
We don't know how that could change. I haven't heard that it's going to change, but the situation in Washington is changing, seems like year by year.
So that may, and then on Oregon, you know, I know Oregon, you know, they kind of decoupled from the federal tax code. So what does that mean for people that have done in this situation?
Yeah, so Oregon has matched federal depreciation rules for a long time.
Right.
Starting in 2026, they have voted to decouple, like you said. And what that means is they've said, we're not going to treat depreciation the same as federal. And so they're not allowing bonus depreciation on Oregon taxable or Oregon tax returns, right? So that means for federal, you get the deduction. On Oregon, you add that deduction back. Yeah.
Got it. Okay, so you're in Oregon, you're almost going back to straight line. Federal, you're going back to the bonus depreciation.
Yeah, it's a good point of clarification. So you do the cost seg study. You still get the 5 and 15-year accelerated depreciation on what the study broke out. So 5 years, it's still accelerated faster than 27 and
You just can't take it all in year one.
You just can't take it all in year one.
I got it. So you're still allowed the bonus depreciation. It's just not able to take it in year one.
You're not allowed the bonus. You're allowed the accelerated.
Accelerate, exactly.
Yeah.
Okay, got it. So that's going to be a little complicated in doing taxes where you've got... So then in theory, you have a kind of a basis for federal and a basis for state?
Yep, that's exactly right. And we have to keep 2 depreciation schedules each year. And then at sale, you would have 2 different gains, one for federal and one for state.
And again, if you do a 1031, which a lot of our listeners are very aware of, that would still, you know, defer those, but you still are running these 2 different bases.
Yep, that's exactly right.
Yeah. Well, I know there's talk now to couple back together.
Yes.
We'll see. You know, as we talk to the candidates coming in, that's What are, you know, as we're kind of wrapping up, what are kind of some of the biggest mistakes you see people doing with this when they're looking and are trying to plan for this?
Yeah, I think two things. On one hand, it's skipping the consideration altogether, saying this doesn't apply to me. 27 and a half years is all I'm entitled to. On the other side, it's maybe acting quickly and not planning for the exit, right? So you take all the depreciation and then you didn't plan on the back end. In both cases, it's not having a tax advisor that knows your situation and knows real estate to help you navigate what's possible and really what's best.
That made me kind of think of like people doing estate planning. Does this affect the stepped up basis at all, or is that is that still in play even if you've taken the accelerated and the bonus depreciation?
Yeah, it would still apply. You would basically step it up to the fair market value the same way that you would otherwise.
Okay. Yeah. And again, if you're Oregon, you'd have a different adjustment, but it's still the end number would still be the same.
Yep.
Okay, so if somebody wants to reach you, they can get you at the website below if they want to have questions. Again, your firm now has a cost segregation group.
That's right.
And then, you know, if they have questions about property and then how that all ties in, you guys are the ones to talk to. So
yeah, exactly.
Perfect. Well, thanks for taking the time to come in and explain this. Again, the big thing is it's not going away. It's in place. Right. And even if you had an asset for a long time, it's worth talking to your CPA. If you don't have a comparable one or you don't have one that knows this, let us know. We'll get you in touch with, you know, Josh and his team, and you guys can, you know, kind of see what the options are is kind of the key. So
yeah, exactly.
And we'll see you next time on Multifamily Market Watch. Thank you.
HFO's entire office specializes in multifamily real estate, making us the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Like and subscribe to Multifamily Marketwatch videos on YouTube, articles on LinkedIn, and podcasts on all major streaming markets. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information. HFO is a partner of the Global Real Estate Advisor Network.
Love the insights? Tap the like button and click subscribe. It helps us bring more multifamily news straight to you.